Hello and welcome to Desert Jewels episode 4. On Desert Jewels, we give you little jewels of information and connect you with people that are going to be able to serve you during your home buying and selling process. Again, we have Andre, our go-to loan officer with Loan Depot. How are you today, Andre?
Waiting on the coffee to kick in. How about yourself?
Okay, I completely understand that because I have not had my green tea yet. So, yes, you all, this is being done in the morning. So, but today we want to talk about something fun. I know you all have seen either online or on HGTV where people do renovations. And today we're going to talk about the renovation loans and refinancing. So, Andre, go ahead and take it away and let us know our renovation options and how they work.
Not a problem. So as far as renovation loans go, Loan Depot right now offers 3 types of renovation loans. We offer the FHA 203K, which that one you've got a standard and you've got a limited. The limited allows a maximum of $5,000 in repairs, and then the standard you have no minimum on renovation costs. Okay. Then you've got the home style, which is a conventional product, and that one allows for luxury items like pools. And then, of course, you've also got the home style investor occupancy, meaning if you're buying an investment property and it needs to be renovated, believe it or not, yes, you can purchase it like this. And yes, you can do renovations on the property by purchasing it like this.
Wow. So let me ask you this. What does the property have to look like for me to be able to purchase it with the renovation loan? Does it have to be slightly damaged, or can I do like I see on HGTV where they go get a home that's full of mold, had some squatters in it, and then we bring it back up to life and revitalize the neighborhood?
Technically, you could go both ways. I mean, you could have a completely dilapidated house where you can do a full 203K loan or home style loan on. And essentially, the way it works is your maximum loan amount is going to be either based off the contract price minus your down payment, or the actual appraised value minus your down payment. Okay. And what I mean by appraised value is they do the appraisal based on subject to completion, meaning that they're going to look at all of the renovations that you're going to do, and they assign the value based on that, not as the home sits. Okay. And then not only, but the way it works is when they do that subject to appraisal, once all the repairs are completed, then the actual appraiser has to go back out to verify that everything you told him was going to be fixed was actually done in order to assign the actual value to the property.
Okay, so let me ask you this. So I have this renovation loan and I want to cut a couple of corners. So I'm gonna hire my cousin's best friend's sister's boyfriend to do the work. Now, will I be able to still get the renovation loan, or do I have to have licensed contractors and service providers to do the work?
See, you can try to cut corners, but ultimately remember, this industry is regulated by the government. So there's no cutting corners. Granted, can you try to cut corners? Yes. If you get caught, will you get in trouble? Yes. As far as the actual people that do the work, they have to be licensed, they have to be bonded, and they have to be insured. And see, what happens is for any FHA loan, so Federal Housing Administration loan, you have to actually get what's called a HUD inspector or HUD consultant. And they will actually look at all the work, they'll look at the costs, and they'll certify that this is legitimate. And the same thing goes for like the conventional home style renovation loans. You actually have to get like an engineering firm to legitimize that this is actually what needs to be done.
Oh,
And
wow.
this is actually legitimate. Not only that, the way the loan itself is worked, you have a dedicated renovation consultant on top of me being your loan officer. And what that consultant does is he or she deals with the contractor bids, the insurance, the bonds, all of that. And then she's also the one that deals with the distributions once the work is to begin.
Okay, so I took Loan Depot offered us like a class about this, and that's what piqued my interest because I wanted to clearly understand. And if I understood correctly, you all want us to get a minimum of 3 contractors to bid on the jobs and describe what needs to be done. Is that correct?
That is accurate. Yes, ma'am.
See, so there's no cutting corners. So I can't get my son's cousin's sister's boyfriend, best friend to do the work if he's not licensed, bonded, and insured and able to meet these requirements. And the home is inspected in phases, correct?
The way it works is the appraiser only goes out twice. Okay. When the appraiser goes out twice, it's the initial appraisal. And of course, with the plans that you guys are intending to do with the home, and then he completes his appraisal based on that, like I said, subject to, meaning that's prior to repairs. And then once the actual work is complete, the appraiser is notified by our appraisal department. They send him back out to do what's called an inspection of completion. So then they verify that everything that was turned into them initially was actually done and was done up to par. And yes, they will check permits too.
And I was going to ask, so this loan also includes paying the contractors for doing the work?
Correct. The way it works is you have distributions at set times. Depending on which loan it is, it could be an initial draw and then a final draw, or you could have 3 different draws at different points of completion. Because, for example, with the FHA limited loan or with the limited renovation loan, you're talking all work has to be completed within 60 days. If it's a full renovation, you've got 6 months to do it. Okay.
Oh, wow. Okay. And with that, because the example that they gave us, they showed us a house where it had been burned and they had to literally take the house back down to the slab and rebuild it. But there's a time frame set for when that construction needs to be completed, correct?
Correct. Work
Okay.
on typically on a full renovation loan, you have to at least have the work start within 30 days of closing and has to be completed at the latest. I believe it's 180 days. There are exceptions to, like, if you're completely rebuilding a home, like from the ground up, I've seen that they've let it go as long as 360 days, but typically they want work completed at 180.
Oh, wow. Okay. So let's go to your renovation loans made simple. Um, and if you'll talk to us about this information on here, please.
All right. Essentially, the way these work is any type of FHA renovation loan, it's to simply update the property. It's not to beautify the property. It's to modernize the home. Like, say, for example, you don't have argon-filled windows and you just got single pane glass windows and your home leaks like a sieve and it's killing you as far as energy costs and heating and cooling and everything else, then yeah, you can do that. If you got peeling paint on the exterior or you've got stucco that's peeling, yeah, you can do that for as far as the FHA loans go. Again, when it comes to FHA renovation loans, you cannot have any type of excuse me, you cannot have any type of luxury items, like, for example, a pool, a spa, an outdoor kitchen, something of that nature. Okay, that's not something that you can include when it comes to an FHA 203K loan, whether it's the limited or the full. It makes no difference. Luxury items are a no-no when it comes to that. Now, on the conventional home style loan, then yes, as long as the value is there, of course you can include luxury items. Meaning
Okay.
pools, spas, outdoor kitchens, pergolas, you name it.
So with the 203K, that's the one that I can use on the home that I'm residing in now because I may not want to move. I see where some things I let some maintenance go without being done, and I see where I can renovate that home and bring it up to par. And I saw on one of the flyers where you were talking about we don't have to take out a second mortgage on it.
That's correct. It's basically all in one. That's what I was saying, is that the home is completed as or subject to completion. Okay. And then when they complete that appraisal subject to completion, it, of course, your loan is written based on that subject to completion value. So say, for example, your home currently is valued, we'll just use a nice round number, $100,000. But then when you turn around and do renovation, say it's going to add $100,000 in value. Okay. So then that renovation, now your home is you're subject to appraisal amount would be $200,000. So then at that point, if you're doing an FHA 203K, now if this is simply as a refinance, this isn't a purchase. Okay.
Right.
Then your total loan amount on that, you'd be looking at probably about $195,500, somewhere thereabouts. Okay. So yeah, majority of those renovations can be financed in. There may be slightly out of pocket, but that would be it.
That is perfect. I mean, because I know sometimes people look at their homes, especially now. One thing that 2020 has taught us to do, we had plenty of time at home to look at, you know what, I might actually need to fix this. And people are deciding, you know what, instead of moving, let me just repair my home. So if you are out there and you're saying to yourself, I just need to do some repairs on my home, I may need to do some renovation on my home, please call Andre to connect with him and let him see if he's able to get you in one of these renovation loans to help you bring your home up, modernize your home to accommodate the number of students you have in your home from college to kindergarten. That's one thing 2020, I even know for myself, you got college students that had to come back home because the colleges were concerned about the spread of COVID. And you should see Andre's number down on the screen is 915-867-7811. Again, it's 915-867-7811. And what I want to do now, Andre, is switch gears just a little bit. Well, one last thing before we leave the renovation. We wanted to talk about what they need to do to prepare for one of these loans, what they need to do to prepare for that. And I think that's your third flyer where you were saying what needs to be done, basic repairs checklist.
Correct. And that's on a FHA loan again. Okay. And essentially you can see on here what the basic repairs are. I mean, you've got everything from peeling and chipping paint to signs of mold and mildew, missing built-in appliances, dampness from water in basements, exposed wiring, missing gutters, damage to the exterior of the home, soffits, fascia, siding, you name it. Cracks in the foundation. Yes, you can fix the foundation, believe it or not. But of course, utilities have to be on and they have to be checked for functionality and all that good stuff. As far as the roof goes, believe it or not, you can actually replace a roof with this type of loan. If you need handrails going down your stairs, like for example, I've got a flight of stairs that I think is 22 stairs or 19 stairs, something like that. If I wouldn't have a handrail there, yeah, I could actually refinance it and pay to install a handrail. But I mean, stuff like that. So, I mean, but of course you can have termite treatment as well. Cause I mean, depending on how bad the infestation is, you're talking about the tens of thousands of dollars for treatments when it comes to termites. So, I mean, there's a lot that goes into these types of loans, but again, it's to modernize and update the home. It's not to add luxuries. Okay. That's what it comes to when it comes to the 203K. Now, if you want to add luxuries, we got to switch gears and go into the Fannie Mae Homestyle loan.
Okay, so now you've told us about the renovation. Let's talk about this hot topic of refinancing. I know you told me that a lot of people were, when they saw these new interest rates, especially those that purchased homes when we were in double digits. I can't believe there are still people that didn't refinance when it dropped down to single digits. And even some of those that got their homes at 6%. Please explain the refinancing program and start with the VA because and please focus on how Texas, because you explained to me how Texas works a little differently when it comes to VA refinancing.
Okay. So as far as VA refinances goes, you've got two types of loans that you can do as a VA refinance. Okay. You can do either a VA IRRL, which is an interest rate reduction loan. It means no credit qualifying, meaning I don't have to collect income docs. I don't have to collect bank statements. I don't have to collect W-2s. I don't have to verify your employment or anything of that nature. Okay. But there has to be a net tangible benefit to the borrowers in order to do the refinance. For example, you have to either 1, reduce your interest rate, 2, reduce your payment, 3, reduce your term. Okay. So ultimately there has to be some sort of benefit in it for the actual borrowers. Now, on a rate and term, that's a full credit qualifying refinance, just like when you purchased. Okay, that means I've got to pull a triple merge credit report. I have to explain inquiries and addresses. I have to collect bank statements. I have to collect W-2s. I have to collect pay stubs. We have to verify employment, all that good stuff. Okay. But hands down, the VA IRRL, the interest rate reduction loan, is the fastest, cheapest, and easiest way to get you guys knocked out. The only thing is, even though there's no credit qualifying, there's no appraisal, there's no termite inspection or anything of that nature, there's stuff that has to be done with the back office, with the VA, that does take anywhere from 2 to 3 weeks.
But in 2 to 3 weeks, if I can lower my monthly payment, I can wait, especially if I've been paying on it for 5 years and we're still sitting in a good place. I know here in Texas, the cash out refinancing, that's the one. You had to explain that to me, how here in Texas that works a little differently for us on VA. Will you explain that for us?
Yes. In Texas, the only way that you can take cash out of your primary residence is with what's called a Texas A6. Okay. And that's a conventional loan. Texas does not allow, it's written into their constitution, we do not allow to actually take cash out other than this type of conventional loan. Okay. And as far as that cash out goes, the only way that you can take the cash out is by switching from whatever loan type you have to that conventional loan. Now, as far as that goes, now keep in mind, this is a very risky loan for investors, meaning Fannie Mae, Freddie Mac, and Ginnie Mae. So the interest rate on that's going to be higher, okay, right from the get-go, because you're getting money back off the equity that's in your home. And most people don't like going higher than 80% of your loans to your home's value. And what I mean by that is, if your home's valued at $100,000, you can't use more than $80,000 out of that equity. Okay. And the reason for that is so that way, 1, you don't have mortgage insurance, and 2, it's not quite as large of a risk for the investor. Okay. And then what happens is, in that 80%, keep in mind, if you don't want to pay any type of closing cost, appraisal fees, or anything like that out of pocket, it has to be rolled into that loan. So once your loan fees are rolled into that loan, whatever the difference is what you can have.
And this is why we call Andre 915-867-7811 when he explained this to me, because I was wondering why I received a notice saying that I had to change my loan to get the cash out of a house that we previously had to get the cash out. But when he explained to me how it works, it's not as cut and dry as we think it is, where if it says that you have $90,000 worth of equity, there's a math equation that goes into that to decide how much of that cash you actually get in hand. Is that correct?
Correct.
Okay, so tell us about the standard rate and the FHA refinancing options.
Okay, so with an FHA streamline loan, okay, the way it works is you get a partial refund of your upfront mortgage insurance premium that you initially paid when you first bought the home. Now, what happens is, we've got a spreadsheet that we plug that into, and when we plug that in, it gives us a maximum loan amount. This is on the streamline, okay? And on the streamline, you're only allowed to roll in a minimal number of closing costs. Perfect example. I've got a couple that want to refinance right now. They originally bought their home for $179,000. Their current loan balance is $171,000. I plugged it into the equation, and it spit out a maximum loan amount of $176,000. So then they would end up having to come out of pocket about $4,000 for closing costs, because when that happens, I mean, keep in mind, you still got title fees that you have to pay. You've got processing and underwriting fees that have to be paid. You still have recording fees that have to be paid and things of that nature. So there's still closing costs. Anytime that you refinance, you're still going to have closing costs, no matter who your mortgage company is. People that say that there's no closing costs when you refinance, it's a lie. I mean, I've seen it advertised, and then as soon as, perfect example, I had a lady argue with me, and she like, well, this company is not doing any closing costs and this, that, and the other. I said, okay, well, do me a favor. Send me a cost of closing worksheet. Have them print it for you and send it to me. And she goes, okay. I got it about 2 hours later, reviewed it, called her, and I did a screen share with her, and I showed her exactly where the closing costs were. All they did was simply roll them into the loan, and they just made it seem like they weren't charging a closing cost, even though they were.
And this is why we trust Andre, because he's going to show you those little fine points. And then there is the standard rate refinancing.
Standard rate and term, that's the same thing all across the board, whether it's conventional, FHA, VA, it makes no difference. Those are all credit qualifying, okay? And it's just like it states, rate and term. So what you're doing is you're either lowering your rate, you're lowering your term, or you're doing both, okay? And those loans, they're 100% credit qualifying. So that means you have to turn in your paycheck stubs, you have to turn in your bank statements, ID, social security card, inquiry and address letters, you have to pay for an appraisal, all that good stuff. Okay, so it's literally the same thing as when you purchase the home, except you don't get any type of closing cost assistance. Now, if you are one of my previous customers, we do pay your processing and underwriting. Okay, that's to the tune of $1,260. And I give a 0.5 point discount on the interest rate for being a repeat customer. So 9 times out of 10, I'm cheaper than anybody else you get a quote from. Not only that, at the same time, I also use the cheapest title company in Texas for my Texas loans. When it comes to refinances, they only charge, I believe it's a total of 4 fees. And that's your lender's title policy, which if you've bought the home in the last 8 years, you get a reducement on that. They charge the Texas guarantee fee for actually recording it, and then they charge recording fees for your mortgage and your deed. So as far as it goes, that saves you anywhere from $1,000 to $2,000, depending on what title company you choose.
Already, because yes, title companies, I think walking in the door is like $1,000 at a title company. And when you were talking about servicing Texas, are you able to assist others in the United States with their refinancing?
As far as refinances go, I'm dual licensed for Texas and New Mexico. So I can do Texas, New Mexico myself. Now, as far as loans in other states, what would happen is I would start the loan out, and I would start the loan as either being in a New Mexico or a Texas loan. And then once I have a complete file, what would happen is I would move it to a local branch in that state, and they would be the ones to complete it. However, I can stay on the file as an assistant, if you will. So if there's ever any questions that don't seem to be addressed by the local loan officer, you can always call me and ask, and I can jump in the file and take a look at it.
And that is what I was going to ask you, but that's who you are. You're always thorough and you always answer the question even before we ask. So if you are interested in a fixer-upper loan where there is to purchase a new property and fix it up, renovate it, or if you want to just fix up the space that you're in and make it more up to date and livable for you and your family, or if you're interested in one of the refinancing options, I know I usually say just call Julie, but on this one, I need you to just call Andre at 915-867-7811. One more time. I know it's on the screen, but 915-867-7811. Reach out to Andre. And Andre, before we go, is there any little loan nugget that you want to leave for the people before we go?
When it comes to fixer-upper loans, be prepared for it to take a while. It's not your standard loan, and there's a lot of moving parts. be prepared to close somewhere between, I want to say 50 to as long as maybe 90 days, depending on how long it takes to get everything certified, get all the bids in, make sure everything's up to par, because not only do the contractors have to turn in their bids, they have to turn in their insurance, they have to turn in their bond information, and everything else that goes with it too, their license as well. So there's all kinds of stuff that has to go on, has to be validated and certified before the loan can close and fund. So it's something that you're going to have to be patient for. Don't expect the loan to close in 20 or 30 days, because that's not realistic. From a realism standpoint, like I said, expect anywhere from 50 to 90 days. And
Okay.
50 days, if all the stars and planets align and everything goes smooth and everybody has everything together and it goes off without a hitch. But 9 times out of 10, that does not happen.
Okay, so you can fix it up, you can refinance, just either one, prepare to be patient. Thank you again for coming and watching Desert Jewels. I hope this information helps you, and remember to reach out to Andre at 915-867-7811. And for all of your real estate needs and connections, just call Julie at 915-539-0524. We'll see you on the next one. Bye.
Bye.